Hit it.
Hi, it's Friday, August the 15th, 2025, episode 270. It's Rupert Mitchell, the blind squirrel, filling in for a once again vacationing Patrick Ceresna.
And I'm Kevin Muir. We had a guest planned, but unfortunately he couldn't make it. Lucky for us, we had recorded the second part with Rupert already, so we still have some great ideas to share. Here's a shortened version of the Market Huddle.
And now back to your regularly scheduled program.
And then this week, there's no talking charts, but we have the good fortune to have Rupert here to chat about two trades that I think are outstanding opportunities.
And folks, Patrick's not here, neither's Daniel, but I'm having a glass of Pinot Noir while I chat to Kev.
Yeah,
it's Friday evening here in Melbourne.
And it's awfully early for me, so it's even too early to drink beer, even for Canadians. So I will be drinking coffee at 6 a.m. here as we record this. Let me just do the side effects here. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before taking any decisions regarding topics mentioned in this show. Side effects of too much huddle may include the jobs jitter disorder, trouble getting that one out, liquidity loss anxiety disorder, and then finally the Patrick signaling the top with an extravagant trip in Europe syndrome. I'm not very good in the morning, no Ripper. It's just too early for me.
I assure everyone it's 6 a.m. with Kev. He's on coffee, and I'm the one on Pinot Noir at 8 p.m. Melbourne time.
Thanks again.
Let's get the other way around, Kev. Normally it's me with the coffee.
All right, Rupert, let's chat. And I just wanted to bring you on because we talk often behind the scenes. And recently you had a couple of trades or ideas, let's call them ideas, that just really spoke to me. And it was something that I was instantly, when I heard the two of them, I'm like, oh, that's terrific. That's a great idea. We're going to start, the second one is going to be oil. We're going to talk about that. But before we do, let's talk about something that not a lot of folks often, have on their radar, and it's restaurants. And one of and are you willing to share that you're actually a little bit of a restaurant aficionado, not just because you go to a lot of them?
Business. No. It's and I told the whole story in my note last weekend. I grew up in the restaurant business. My mother and stepfather ran a really kind of, it was kind of a mecca restaurant in the 80s, where royals and celebs and everyone used to be a favored watering hole for them. And
that was in London. That was in London.
In London, and I mean he opened it in 1980, and then closed it in 2005. So by which there's almost zero sort of internet existence of this restaurant because smartphones became available a couple of years later.
Was the good fortune to have like Lady Di there and like
So Lady Di used to sneak there for dinners, and Sarah Ferguson had a hen night there.
Oh wow!
You had a hen night there, and the Daily Mail gossip columnist Nigel Dempster used to sort of hold fort in the corner table of the conservatory every Friday lunchtime, and
really?
So it was that kind of place. It was awesome. A real institution. I tell you what, those walls have some stories to tell.
That's right.
It's funny because back in the 80s and 90s we had real business cycles, right? And actually, I put a chart in my notes of just UK monthly GDP prints over the life of the restaurant, and it's a real roller coaster.
Right.
And the thing about the restaurant business is you are super sensitive to any twitches or shifts in the business cycle or the economic cycle. It immediately shows up in weekly takings, to put a bit of macro hat on for a second, I think that a lot of us have been sort of truly scarred recently by making sort of premature recession calls around the US economy. And, we blew up put premium at the beginning of 23. We reached for bonds too early. Even if we hate bonds, we occasionally got onto the long side, and it was still too early. And I actually, I'm not that guilty of it. I own some of the front of the curve, but I'm still avowedly not a fan of the long bond. But we've got this weird situation because of what's going on with the AI capex. The the headline GDP numbers might tell a slightly different story this time, because when you include all of that activity relating to carpeting rural America with data centers, you've got a situation whereby the other 99% of the 99% of the economy is sucking wind.
Right.
I mean, classic Atwater's K-shape. And it just struck me that the listed restaurant sector, which has historically had been a really good leading indicator in terms of the stock prices of restaurants, has been a really good leading indicator of personal consumption.
Right.
And so I put together a sort of basket of restaurant shorts. Now, the way to look at this space, you've got full service restaurants, you've got fast casual restaurants, and then you've got the QSR, which are the fast food joints. Right. Now, they all get slightly impacted in different ways, but really the full service guys, where they have a lot of fixed costs about which they can do very little, are to my mind, the most in danger of they're already seeing negative comps in terms of same store sales, and they're not cheap stocks. I mean, the full service restaurants are valued at a discount to the broader equity market, but they still don't feel cheap here.
Yeah.
But so there's that category, and so in that you've got sort of Darden's, which is the home of the Olive Garden. You've got Brinker's, which owns Chili's. You've got the Cheesecake Factory. You've got Cracker Barrel, and you've got.
It's so funny hearing a Brit talk about all these American. Have you ever stepped in any of those restaurants, Rupert?
Not at all, but I watched that sitcom where Penny worked at the Cheesecake Factory. So and then the last one in the category, which is the only one I've taken any action on so far, is Texas Roadhouse, which is extraordinary. I mean, and that's valued at something like $14.5 million per restaurant, right?
Wow.
But where there is a real valuation crime is with fast casual. And so by that, I'm talking about the Chipotle, which has haunted us all for years. And you've got restaurants like Carver, Sweet Green, Shake Shack, all of those guys. And this is extraordinary, just in terms of the, some of the sort of valuation crimes that have taken place there. So I managed to put positions on in short positions in Carver and Starbucks on Monday. I published a note on Sunday.
Which was before, by the way, before the Carver shit the bed, and there's no other way to say it.
Yeah, so Carver was valued pre-earnings at $25 million per restaurant. Right? I can tell you, my stepfather didn't get that for his. 20, and these guys sell overpriced hummus and pita bread. Anyway, the Carver went for a sort of 22% haircut post earnings. But even after then, it's still valued at $20 million per restaurant. So I think this trade's got plenty of runway.
Yeah, and it's what's nice about this is that you're shooting something that's going down, right? Yeah. And that yet is still expensive, meaning you're not waiting for you're not shooting something that's overvalued. Like recently I saw Andrew Lefter, one of the short sellers, talk about Palantir, and he talked about how stupid the pricing was and how expensive it was. And he's probably spot on correct. And I'm sure in a year's time that it's going to be lower. But in the meantime, it just keeps going up, and it's just a world of pain. Meanwhile, these are already rolling over. They're already agreeing with you. So yeah,
the charts are pretty. I mean, so some of the full service ones, the charts don't look too bad. So the Olive Garden one, Darden's, is actually a stock that you wouldn't take on right now.
Right.
But okay. The other thing, so the two things I looked at, one was the chart. I didn't want to, I'm going to wait on Shake Shack and Chipotle because they're just too oversold at the moment.
Okay.
And then there are some of them with elevated short interest that you really don't want to go too close to. Right. And there are some where I'm just waiting for, our favorite topic, Kev, the negative earnings revisions to kick in.
Yes.
Yes. And so I sort of ranked all of these three sections by what we were doing in terms of EPS revisions, where we were in the chart, what we were valued. I love putting valuations into real world metrics, like market cap per restaurant, because if you don't do that from time to time, you kind of really lose track of reality sometimes.
Yeah, for sure. And as I said, these things are already going your way. They're turning down. Could you talk a little bit about the bigger thesis, though? Why do you think that the consumer's under pressure and that this will be a problem going forward?
Well, I think that the disposable incomes are dramatically under pressure. So if you think about the customers of these dine-in, the restaurants, the Olive Garden style restaurants, 70% of their customer base spends less than $200 a month in these types of outlets, right?
So it's the lower end.
But the point is, what you always forget is that it's a vast cohort of the population by number, right? Mm. And if these guys are cutting back, it's going to show up in these guys' weekly takings really quick, and the comps are already rolling over. It's very clear what's happening. Right. And in the sort of more racily valued fast casual segment, you've got the management teams focusing on psychobabble KPIs like sort of wellness quotients and things like that, because they cannot talk about same store sales.
Right. Got it. Okay.
And so many of those guys were being valued on some kind of disking. Carver, for example, has got it's got 380 stores right now, but they're constantly talking about 1,000 stores by 2032. And I guess the sell side analysts are trying to sort of discount back a business that has 3x the footprint in 7 years' time. And that just doesn't work, right?
They are trying to do this sort of growth in an environment that in an industry that's hugely cyclical, back to your original point. And there's no doubt about it that the low end consumer is under pressure, right? Like we've just gone through this.
The low end. Yeah, definitely. Yeah. But I actually think the low end consumer. So the low end consumer started in terms of excess savings. That dipped into negative last year, right? And these businesses are not growing that spectacularly. I think the fast casual revenues are kind of growing from here to fiscal 27 at about just over 8% on the top line and about 8.5% at the EBITDA line. It's not spectacular, right? I mean, I just don't understand. Why they would command sort of software multiples. So the software segment trades at 72 times forward earnings.
Yeah. To me, it just feels like this big, beautiful bill, very regressive. And the regressive nature of it is actually meaning that a tax cut for the wealthiest. And what do the wealthiest do? They go out and they put the money back into the market. And so it's easy for me to understand why we're having the Mag 7 / the AI, the dream stocks ripping higher. But meanwhile, this regressive tax is actually putting pressure on the low end of the economy. And to me, when I heard your trade, I was like, this is the perfect way to express it. Don't worry about going and fighting, the Mag 7. Go, sell the things that.
Also, it may be a situation whereby, even short-term interest rates are quite tough to get right now, right? It's tough to see, huge positive expected value trades in either direction right now.
Because the front end keeps running ahead, and so you need a real bad event to occur for you to make money at the front end.
Yeah, exactly.
And this might be the drip lower.
This is what you dream of. So actually, there was a little bit me that was a little bit disappointed by what happened on Carver. Yeah, it's a wonderful thing to sort of to have an earnings
the market gods by complaining about that, Rupert.
No. But the reality is that you want these things to just grind down,
Yeah.
right?
Right.
You just I'd love to be able to sit in this for 9 months,
Right. I got
12 months.
Okay.
And
Let's move on to the next trade. And as I mentioned, this was another one. When you started chatting, you started telling me this theory. I was like, oh, geez, that's brilliant. And not enough people are talking about it. And I was like, let's get you on the show. And it was this one specifically that I wanted to talk about. It's oil. And we're going to present a bull argument. But before we do, just to show we're not idiots, why don't you tell everyone the bear argument that everybody knows? Like, let's just go over and let's just say, okay, we know this is the bear argument. Tell us all the kind of the problems out there and why the majority of folks are bearish oil. And then after that, we'll kind of present the variant perception about what they might be missing.
Well, there are a number of reasons to sort of to prop up a bearish oil case. I mean, there's the macro, the Western macro picture, a growth slowdown, whatever you want to call it. That's always there's the view that there's plenty of abundance. People can turn on taps, relieve. The Saudis can pump more. War can end. Russian oil can come back on the market. You can choose to ignore or not ignore Iranian oil any day of the week. All the brilliant reasons. But I think that, and let's be very clear, I do absolutely not. I've done very little at the front end of the crude curve for a long time now. Right. I'm really just not interested in frankly the front 12 months. And so my big thesis around this is that, and this has been true of all of the big research teams, whether it's the IEA, and to a much lesser extent the OPEC research team, is that when it comes to estimating future demand, potential demand from the global south, I mean, it's not even a footnote, right?
Right.
And so
meaning that they work really hard talking about researching supply,
really hard figuring out incremental barrels consumed in driving
and that is
season.
what the market is focused on. It's all supply. You listen to Paul Sankey, brilliant analyst. He's only talking about supply. You very rarely hear the demand side of the equation discussed.
Yeah. And the missing piece of the jigsaw is, Africa that currently consumes less than a barrel per capita per annum. The whole continent of Africa right now. India, population greater than the EU and the US combined. EU and North America combined.
Right.
1.4 barrels per capita per annum. Now, are you really going to paint a energy productivity picture such that, they don't need to get to, Africa doesn't need to get to even close to 1.5 because of solar, blah, whatever, right? Or are you saying that actually the fastest growing population on the planet, right, which is Africa, is going to be net per capita consuming less energy, where they barely consume a teacup right now. I just don't buy it.
Right.
So,
and specifically, it's like a lot of folks, I think that the new age folks would say, oh, but that's all going to be electric. And you have a different theory about that.
Yeah, no, I really do. So the week before last, I wrote about an African e-commerce business called Jumia, right? And I've been onto this for a while. I think that Africa and African equities is a stealth China trade, right? Yeah. Africa's resources and its potential to be a vast consumer in the future is very much within the sniper sight of China's organizers. And all of this tariff-related breakdown of the acceleration of the multipolar world has suddenly made Jumia's as Jumia as a customer that buys cheap goods from China significantly more important.
Right.
Now, Chinese exports have been accelerating, as we all know, over the last couple of years, and the big ticket item of exports is obviously cars. Now, China makes 31 million cars a year, right? Just to put that in perspective, the US is at 10, 11, Japan's at 8, Germany's at 4.
Wow.
Yeah.
Wow. I didn't know it was that. Like, I knew it was a lot. Like, if you made me guess, I would have guessed high, but I wouldn't have guessed that high. Wow.
Yeah. I mean, it's historically, I mean, it didn't start exporting cars in any meaningful number until 2 years ago. And this thing has just roofed, right? Now,
Right.
I mean, the BYDs and the Great Walls, basically all of the Chinese brands are here in Australia now. They're all over Southeast Asia. They're all over LATAM, but they're going to Africa as well. And there are some EVs going, and EVs are part of the story for polluted cities in India. I get all of that, but it's many more hybrids and internal combustion cars that are going. And
right.
And so the key part of this energy thesis in Africa is that if you can put an efficient internal combustion engine car on the ground in Nairobi for less than $5,000,
right?
What do you think that does to vehicle penetration numbers?
Yeah.
Yeah. You're talking about a sticker price that's 30% of an entry level four-wheeler historically.
Right. And for me, I always talked about the hockey stick of energy consumption, meaning that as a country got more prosperous, it eventually hit a point where the consumption per capita increased. And that was, again, not taking into account the fact that you could also have that consumption change because the price of the thing consuming the energy changes. And that was the big aha moment for me. I was like, okay, I've always been waiting for Africa to get, wealthy enough to be able to afford cars. But really what's happened here with China bringing down the cost of cars to just absolutely low levels, we could increase the per capita energy usage because cars have become so cheap.
And guess what? Yes, there's going to be an EV story, but you can't go to passenger transport by electric before you fixed air conditioning, right?
Yeah.
So they need to get through. They need to get through. If you think of, the pyramid of needs, right?
Yeah.
It's ultimately, yes, the car is a little bit further down the queue, right? They've got to prioritize heating and cooling.
Completely agree. And so
just in terms of, to your point, so a really good example is like sort of the Asian tigers of Southeast Asia. So, I mean, I looked it up actually earlier today. So, in terms of per capita barrel consumption, Thailand went from 1 barrel to 5 barrels in 8 years.
Wow. Yeah, that's the hockey stick. It just goes chug, and then just boom.
Whoop.
Yeah. And so this is something, and I think like as I mentioned, the part that really clicked for me was I always assumed it was going to take them becoming wealthier, and I didn't ever consider that it could be the efficiencies of building these things will come way down. And that's the part that I think a lot of folks are missing. And when people talk about oil, nobody is talking about demand, and zero.
So what I do, Kev, is I for the last sort of year and 2 years now, I've run something which I call the Squirrels SPR, right? And so what it is I own at the moment the December 27, 28, 29 and Brent 27 crude contracts, and every year I roll. So this year I'll roll the the WTI 27 to WTI 30 and pick up, well, it's quite volatile at the moment. It's only at the moment 75 cents of roll yield, but back in April, that would have been $3 of roll yield. Yeah.
Which is crazy.
Which is crazy, right?
It used to trade the other way.
And actually, one of the Paul Sankey was actually one of the key sort of germs for this idea, because we should be, when everyone's so obsessive about real assets, right? What's more real than a barrel of oil?
Yeah. What's more important to the economy? We sit around trading gold, but it's actually kind of useless. Oil is in everything we have. It is the purest expression of wealth.
Yeah. So I don't own bonds. So I have an allocation to these long dated crude contracts, my SPR.
Right.
That's a core allocation.
Well, that's actually brilliant.
And then on the equities front, I've just terminated an abusive relationship with the oil refiners. That was this week. Finally, the 3-2-1 crack spread dipped through the 200-day, and I said no mas. And
Paul Tudor Jones would be proud of you. Paul Tudor Jones would be proud of you.
I basically it was a hero trade last May 24. And then I round tripped the entire thing, and I was just about to go negative on the trade. And then the crack spread dipped below the 200. I said, no, I'm not going to take a loss on the trade. Anyway, so I'm out of that. I also am a bag holder of offshore stocks, but I started in those so early that I'm still in the money, even though I've worn a nasty drawdown, ignoring your words about earnings revisions. And then like a true fellow colonial, I have my Canadian oil mafia basket.
Oh, there you go.
I own a basket of 7 of the local favorites over there.
Do you really?
Street favorites. Yeah. Oh God.
Do you want to share us the names? You share the names?
Yeah. I mean, they'll be so familiar to all of your crew, but it's Meg, it's Baytex, it's Synovus, it's Suncor, it's CNQ, but then I got 2 gassy names in the form of ARC and Tourmaline.
Nice. Geez, you were gonna call you a Canadian with a portfolio like that.
There you go. And I benchmark myself against Eric Nuttall.
Well, listen, Eric, I'm still laughing about that. That's like when people choose to bench themselves against what is it? Instead of using the S&P, they like to bench themselves against the Russell because the Russell's not as good at index.
No. I think Eric's the OG of
well, you got to give him credit for sticking with it. There was for those who don't know, Eric Nuttall is a Canadian oil portfolio manager, and I think at one point he was the only, or maybe there was 2 funds left that were energy funds in Canada, and I think his mutual fund was down to literally $10 million. Like it was just nothing. Like why they were keeping this thing alive, and he was still coming on TV talking about his picks. And now it's I don't know if it's $1 billion fund, but it's big. It's got.
Listen, back in late 2021, I actually wrote about this when I initiated the port. The Canadian oil mafia #com on Twitter in those days was a force to be reckoned with, and Eric Nuttall was the high priest of the Canadian oil mafia,
the Tony Soprano of the oil.
And they used to sort of have 7-hour spaces calls where they talk about Eric's picks. It was something else. This all used to happen because I was in Hong Kong at the time, and these late night spaces calls in East Coast time would be going on in the background as I was sort of making breakfast in the morning. Well,
I'm glad we rubbed off on you in some way. Rupert, it's been a real pleasure having you. Let's just, we're going to call it a day here. Why don't you tell people where they can find more about your great letter and, you yourself.
There we go. It's so easy, Kev. I'm mimicking you. It's very easy. blindsquirrelmacro.com. And it all leads from there. I'm reasonably active on Twitter. I'm on the Blue Sky. I sometimes stick my nose into LinkedIn, but I'm at Squirrel Macro on Twitter.
All right.
But blindsquirrelmacro.com gets you to all places.
And you guys know where you can find me at the macrotourist.com. Bull market, bear market, we're just happy you guys are spend some time with us. Now stick around for the after show. So you know what? I've sprung that on you, Eric.
You know, Eric.
Eric,
I am the new Eric Nuttall.
Yeah, the new Eric Nuttall. Rupert, but why don't we do a quick little after show? Why don't you you got anything big planned? Now it's winter for you, right? So you guys, it's cold weather. What's the weather like there?
It's actually, I mean, you know, it's not even close to spring yet. Actually, it was pretty. I mean, it's single digit centigrade. I mean, it's not proper. It's not Toronto cold, but Melbourne gets quite.
It's cold for you.
I'm actually I'm traveling a bit. I'm going up to Hong Kong in a couple of weeks for a couple of days, and then I'm going to the UK for most of the month of September.
Oh, okay. So well, that's a nice month to be there. All the tourists are gone. Nice weather still.
Well, sometimes you can get lucky with an Indian summer, but expect leaves and rain.
Really? Like, so I've never been. Like, when does it start raining? Like, is it like in the fall?
No. It's London, so there's always a risk of a shower. September's. I do like September. It's.
Do you miss? Back. By the way, do you miss London?
It's been such a long time since I lived there. I haven't lived there full time since 2009.
Oh, okay. Well, do you miss it?
Not really.
Like, I saw Chris Arnaud, the wandering,
he's in Australia.
I know, that's what I was going to say. But the reason is, for those who don't know, Chris,
I'm a subscriber. I'm hoping he said he might come. Melbourne's not on his route, but he said he might swing by Melbourne. I want to go for a walk with him.
Right. For those who don't know, he's an ex-Wall Street trader of some sort, and he's, he quit and he's gone on this journey. He's like photographed, rural America. He goes and he lives
sits in McDonald's. He sits in McDonald's and chats.
Yeah, he's almost he lives almost like a hobo. Like, he's like going on Greyhound buses all around the world or all around America. He's photographing and talking to people. It's a wonderful, and he's a terrific writer. I think we've spoken about that. Yeah, he's just absolutely terrific. So we should actually, if we're going to talk about it, why don't we tell people what is it, Chris? So how do I say it? It's A.R.
Arnaud, right? Isn't it Chris Arnaud?
Yeah. Let me just see here. We'll tell people. But anyways, he's in, here he is, American photographer. And it's Chris Arnaud, Walks the World, Substack. And I read a piece recently where he, went to Australia. I think it's his first time. And this guy is well-traveled. Like, this is a fellow that has been around the world. And he said the Australians are the nicest people he's ever met. That was it. He was just like,
I have to agree. I live here. It's my home now.
Yeah. And it was just like, and when he started,
I'm married to one.
Yeah. when he said that, now he's in Sydney, I think he said, when he said it was a mixture of California and London, I was like sold. I was like, I wanted to come. Yeah, like, literally, this was the best tourist ad that he's ever done. But if it wasn't for your terrible time zone.
It's that he was deeply discomforted by that, because he actually likes to live a little bit tougher. It was too comfortable for him.
Yeah, that's right. The people were too nice.
You and I were not like at all.
Exactly. We're not looking for that gritty.
A little bit too much grit. Yeah.
That's right. Okay, well, on that note, everyone, have a great week, and we'll see you in a couple of weeks.
Take care. Thanks, Gav.
Thanks.